What is cost volume profit analysis? This analysis is also called break-even analysis. CUP analysis is the analysis of three variables, that is cost, volume and profit. Such analysis explores the relationship existing amongst cost, revenue and resulting profit. CUP analysis could be helpful in the following situations. First one, budget planning. That is to determine the sales volume required to make a profit. And second one is to make decisions regarding pricing and sales volume. And third one is determining the sales mix of different products. That is in what proportions each of the products can be sold. What are the assumptions of CUP analysis? Expenses can be classified as either variable or fixed. Second assumption is CUP relationships are linear over a wide range of production and sales. Third assumption is sales prices, unit variable cost and total fixed expenses will not vary within the relevant range. Fourth assumption is volume is the only cost driver. And what is fixed cost in CUP analysis? These are the costs which are incurred for a period and within which certain output and turnover limits and tend to be unaffected by fluctuations in the level of activity. For example, it includes rent, insurance of factory building, etc. And it remains the same for different levels of production. And what are variable costs in CVP analysis? These costs tend to vary with the volume of the activity. And any increase in activity results in an increase in the variable cost and vice versa. For example, cost of direct labor, direct material, etc. You can see the variable cost and fixed cost graph here. The slanting line is called the variable cost and the fixed cost remains unchanged, that is the horizontal line. And together, if they are added together, you will get the total cost graph. What is break-even analysis? Break-even analysis is used to analyze the relationship between cost, volume and profit. At break-even point, the total revenue covers all fixed and variable cost, resulting in zero profit. That is, it is a point of no profit and no loss. Break-even analysis helps us to make a decision for making a product or buying a product. And break-even point in units is equal to total fixed cost divided by selling price per unit minus variable cost per unit. And this selling price per unit minus variable cost per unit is called the contribution margin per unit. The break-even point, that is in sales value or turnover, is equal to fixed cost by PV ratio. PV ratio is the percentage by which the selling price or revenue per unit exceeds the variable cost per unit or contribution margin as a percentage of revenue. You can see the graph here. You can see the total sales revenue line and total cost line. Both these intersect each other at a point. That point is called a break-even point. Below break-even point, we have the loss area. That means the company is making losses. And above break-even point, the company is making profit. That is the profit area. The x-axis, it is the units sold, and y-axis, it is the sales in rupees. So fixed expense will remain constant and variable cost increases as the number of units increases.